How you doing, everyone? This is John Darsie here for the T3 Live Daily Recap, filling in for Scott Redler, who's on his way to Las Vegas for the Traders Expo. If you're in the area, make sure to stop by I believe it's at the Caesars Palace, to say hi to the team. Scott will be giving some presentations on behalf of Schwab, and the rest of the guys will be giving presentations at our booth all throughout the event. All right, another tough day for the market. The S&P broke definitively below its 200-day moving average, the level we've really been talking about a lot. We can go straight to the chart here to take a look at that break. In the Off the Charts newsletter and the price point sheet, and Scott in the morning call and daily recasts have been talking about the importance of that 200-day moving average. And what traders like to see is a nice bounce when we come into that level. They don't like to see the market break down and then consolidate, around a major level like the 200-day. We've stated repeatedly that the longer that we hover around, that 200-day level, the more likely we are to break down and get another leg lower, and that's what we saw today. The major catalyst seems to continue to be the fiscal cliff. President Obama today gave his first press conference since being reelected, and the market doesn't seem to like much when President Obama speaks. Once again, we sold off on his remarks as people are very pessimistic about whether or not we're going to be able to come to a compromise. And the major concern is that we're just going to continue to get the type of stalemate between the Republican-dominated Congress and the Democratic White House that we saw the previous 4 years. This market's also suffering sort of a leadership crisis, and that continues. We can go to the chart of Apple. Something that we always talk about and cover here at T3 Live. Ooh, I got the fibs on. Sorry about that. Apple is sort of in no man's land since it broke below its 200-day moving average. That's a big complexion change when we see a break below the 200-day, and now we're seeing all the major moving averages curl down, which is a very bearish sign for Apple, and especially when you see the 200-day moving average curling down. It's a very bearish sign. And right now, Apple didn't break below its, recent pivot low the way the market did. But you're seeing it consolidate in the lower end of this range. And, based on the way the stock has been acting, it feels like we're going to see another break. If we go over here to the left, major support, I believe it's 528.66. That's the level to watch going forward. And based on the way Apple's been acting, it feels like we're going to test that level, and it's possible we could break it. When the stock was trading above $700 a share, a little over a month ago, it's hard to imagine us testing these deep of support levels. But a big thing is you can't be blinded by a symbol just because it's Apple. You can't break your rules and try to blindly buy a stock. You got to use levels and trust your moving average and stuff like that. And with Apple, it's just even though it's Apple, we're not compelled to buy it at this point. Some other things today. Abercrombie Fitch had a big day after earnings. That'll be good for the retail sector. They reported, I believe, stronger international sales, which allowed it to bounce hard, reclaim its 200-day moving average after pulling back over the last few months. The stock had been flying high, over $70 a share. Had lost half its value, so it seemed that they were not pricing in a very good report, but the report was good enough to send it higher. I believe it finished 35% higher, something like that. Obviously an enormous day for Abercrombie Fitch. Facebook was also a big focus. I think a lot of traders had their eye on this as a potential short, as 800 million shares were exiting the lockup, the IPO lockup period. This is the biggest IPO lockup expiration, and a lot of people thought the 800 million shares that were going to flood the market would weigh on the stock. But in fact, traders use this as an opportunity to squeeze those shorts. And the stock had a very big day, as I'm sure you know if you were out there trading. I believe Facebook finished the day up over 12%, a monster move. It'll be interesting to see whether Facebook can hold these gains with all that new supply out there. 800 million shares represents 35% of the outstanding shares, which is an enormous amount. And it'll be interesting to see if those insiders start selling blocks of those shares and we get some selling pressure after today's big move. Another thing to note today was the Israeli strike on the Gaza Strip triggered a 1% move in crude oil. In the Middle East, tensions are rising and are threatening to really boil over after Israel killed Hamas's military leader. And some other Middle Eastern countries are starting to voice their displeasure about Israel's strikes in Gaza and their escalation of that conflict. And that's sure to raise tensions and not be a great thing for the market. But it could ignite oil, as there could be potential supply disruption if we get an escalation of those conflicts in the Middle East. Another one to note is Cisco had earnings last night, and it gapped up hard on that report. But while it couldn't hold the whole gap, it did hold at least half the gap, which is fairly bullish. We'll see how this reacts in the coming days. But this is at least a good sign for the tech sector, which has really been beaten down. But Cisco, we'll keep an eye on that in the coming days, and it could be a swing long if it can bounce after filling some of its gap today, but holding half. Those are the major highlights for the day. Traders have been looking for a bounce in this market, but there's been nothing really in the technicals telling us that a bounce is going to come. So, obey your rules, take it slow when the market's in correction. We're at oversold levels right now, but we're not really at extreme oversold levels that, necessitate really aggressively looking for a bounce. So continue to sit on your hands, continue to be cautious and patient. Especially we have options expiration on Friday. That's another reason to take it slow. Sometimes you get wacky type trading heading into OPEX. And then we also have the Thanksgiving holiday next week. So it's likely we'll see volume and volatility dry up a little bit. So, don't sit there and chase things that aren't happening in the market. Take it slow, and if you're having a good week, a good month, sit on those gains and be happy with what you have. This is John Darsie with the Daily Recap. Have a good night.